Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Mok-yeon. South Korea's benchmark KOSPI has broken above the 7,000 mark for the first time, driven by strong gains in semiconductor stocks. Korea's stock market capitalization has now risen to 7th in the world, and some analysts are even raising the possibility of the KOSPI reaching 10,000. But despite the market rally, concerns are also growing over rising volatility and a surge in leveraged investing by retail traders. Oil prices are also fluctuating again amid uncertainty in the Middle East, adding pressure to inflation and consumer sentiment here in South Korea. So tonight, we take a look at whether the current rally can continue and what rising prices could mean for the broader economy. And for this, we connect to Shin Se-don, professor at the Division of Business Economics at Sookmyung Women's University. A very big welcome.
Good evening.
And also joining us is Kim Yong-jin, professor at Sagang Business School. Good to see you again, Professor.
Good evening. Pleasure to be here.
So let's start a discussion first with Professor Shin. So like I've said, the KOSPI, it recently broke above the 7,000 mark, and we hear semiconductors are seen as the key driver behind this. I wonder, what is your analysis of this current situation?
Well, I would say this is unbelievably amazing kind of surge in KOSPI index. Stock price went up from 2,500 last year to 7,500. Which is about 3 times, and market capitalization was about 2,000 trillion won last year, but now it is over 5,000 trillion won. I couldn't have dreamed, in 1984 when Samsung first able to produce primitive DRAM, which is a 64K DRAM, was able to produce that, and at the time, KOSPI index was 150. And market capitalization was 5 trillion. You just calculate how great the surge has been for the last 40 years. Definitely, it is a structural shift, but it was a long, delayed one in the sense that it took so long, for Korean stock market to rise up to 7,500. So I think it is a structural surge. And I believe it's going to stay there for some time, but the only concern now is about the pace of surge, about 3 times, 300 percentage point in 1 year, and the 2.5 times, pace in increased market capitalization. I think that's a little bit too fast, and there are many people worrying about that, but I'm pretty confident that it's going to stay there for some times.
Wow. So it really is a very remarkable achievement. But alongside this market rally, retail investors are rapidly increasing leveraged stock investments. And given that, with market volatility also rising, Professor Kim, what about you? Would you say the stock market is currently in a stable growth phase?
Because I don't want to, kind of hurt Professor Shin's expectations, but I think it is hard to say that, while the South Korean stock market is currently experiencing a historic rally, it would be a stretch to call it a stable growth phase. It is more accurate to describe it as a high momentum expansion with elevated structural risks. It is, manifesting that the rally is backed by genuine and fundamental improvement, including record-breaking earnings from semiconductor giants. However, as you noted, the stability is undermined by the sheer volume of leveraged investment, with margin loan balances hitting all-time highs, which is surpassing 36 trillion won. A significant portion of the recent gains is built on borrowed money. A high, leverage may create a domino effect risk. Even a minor healthy correction can trigger margin calls, and leading to forced selling, which then accelerate the downward spiral. This can be indicated by the frequency of volatility interruption activations, which has doubled recently. It suggests that while the trend is up, the path is, incredibly jagged, indicating that investors are reactive and nervous. Moreover, the market remains sensitive to external shocks, such as fluctuating oil prices due to ongoing Middle East tensions. Highly leveraged market, this external black swan event, have a much larger impact than they would in a cash-rich market. In sum, the Korean market is in a robust bull market, but the stability factor is low. The massive influx of retail leverage has created a fragile floor. It is a phase characterized by high reward, but high systematic vulnerability.
Thank you so much for that opinion. Of course, we're open to any different kinds of opinions, so you don't have to worry about that, Professor Kim. But now, going back to Professor Shin's kind of a positive outlook, other major domestic and global brokerage firms are now raising their KOSPI forecast of up to 10,000 points. Professor Shin, what about you? What is your outlook, and what kind of variables could ultimately limit the rally?
Yeah, just just looking at the fact that the stock price went up from 2,500 to 7,500 in less than a year, and if we continue that pace of surge, reaching 10,000 is not an impossibility. So I think for the time being, it could reach 10,000 during this year. Problem is, could it stay there for long enough? Couldn't there be any major correction? In that respect, I think I agree that there is a severe kind of possibility of potential risk. And that risk, I think, is about interest rate hike, not just in United States, but in Korea. And also there's a global geopolitical risk, not just in the Middle East, but in other parts like Ukraine or, southern Pacific. So there's a pretty much of a potential risk. So I think we could not stay even 7,500 for a long period of time. We would have a correction probably down to 6,000 or probably 5,500, but it is not, the situation that we had in 2025 when the KOSPI was 2,500. So I think there's a structural shift from 2,500 possibly to 4,000 or 5,000, even 7,000. In that respect, I think this surge is stable, even though there could be some possibility of, fluctuations, down several hundred points, up several hundred points. But I think we have reached a period of structural surge from 2,500 to possibly 5,000.
But despite these positive outlooks from various places, the stock, many people are still kind of feeling that the real economy, it's facing real problems. In particular, Korea's consumer inflation rate for April climbed 2.6%, which is the highest level in a year and 9 months as well. And inflation is expected to rise even further this May. Professor Kim, how are you looking at the inflation outlook right now?
Well, and I believe that the inflation outlook for South Korea is currently characterized by high uncertainty and persistent upward pressure, largely due to the external energy shocks and domestic supply factors. While the stock market reflects high expectations for technology export, as you mentioned, the real economy is struggling with a cost of living squeeze that is unlikely to ease in the immediate term. I would say in the short term, we'll have a continued upward pressure. The Bank of Korea expects inflation to rise further in May. This is driven by the continued impact of high global oil prices and a base effect. As prices for agriculture and fishery product fell significantly during the same period last year, making this year's year-on-year comparison appear higher. And global oil prices, have spiked due to the effective closure of the Strait of Hormuz following geopolitical conflict. Diesel and gasoline prices in April already jumped to 30.8% and 21.1% respectively, marking their sharpest increase in nearly 4 years. a weaker Korean won is exacerbating the situation by increasing the cost of imported goods and further fueling imported inflation. This situation is reflected on public inflation expectations, which have risen to 2.9%. This means that consumers anticipate price to stay high, which can lead to a sticky inflation environment where wage demand and price hikes reinforce each other. So I believe that the disconnect between the booming stock market and the difficult real economy will likely widen. And high interest rate intended to curb this inflation will continue to put pressure on household and small business through the summer.
All right, so this is a very concerning situation indeed. But if this oil-driven inflation continue to accelerate more seriously, Professor Shin, could you tell us, explain for our viewers, what kind of ripple effects could we see in interest rate policy and the exchange rate as well?
Yeah, if inflation rate goes up beyond 3%, that's going to invite Bank of Korea to raise interest rate. And knowing that the factor of Korean higher inflation is not confined to Korea, it is a global phenomenon. So the United States inflation will go up, and America should also raise the interest. So if inflation persists, the global interest rate has to go up, which means that dollars is going to get very stronger, and one's exchange rate won has to get weaker, which we experienced a few years ago. So interest rate hike and the weakening Korean currency is the most important kind of a ripple effects that we could expect from this wave of inflation. But problem is, many people are talking about inflation in Korea, which was 2.6% the month of, I think, last April. But to me, Bank of Korea is concerned about core CPI, which was 2.2%. So 2.2% inflation is not something that we have to seriously worry about. Of course, if the oil shock continues more than a couple of months down the road, that may bring a significant worry. But for the time being, and believing that Iran conflict is going to end sooner or later, I am not the kind of person too much worried about inflation. So I think at the current moment, at least, inflation is not something that we have to worry about.
Like Professor Shin has mentioned, oil prices, international oil prices, initially fell on hopes for possible U.S.-Iran negotiations, but it turned higher again as reports of clashes have emerged. Professor Kim, so as this oil price volatility continued to grow, what kind of impact could it have on consumer sentiment here in South Korea?
Before I get to the point, I appreciate Professor Shin's, optimistic view about inflation. I like that. But, it is, really impossible to tell how things are going in the near future. However, one thing which is very, very clear is that all of this problem caused by, the U.S.-Iran, conflict, right? And even the fresh military strike in the Strait of Hormuz yesterday have disrupted a critical choke point that handles approximately 20% of the world oil supply. The oil market is currently caught in a cycle of headline volatility. Prices initially dipped in early May on rumors of peace deal, but they sharply reversed the following report that the U.S. struck Iran military site in retaliation for attacks on U.S. warship. Now, Brent crude has been fluctuating between $95 and $115 per barrel, while a fragile ceasefire is technically in place. Peace remains elusive, leading to intraday price swings of 3 to 4%. If the Strait of Hormuz remains contested or closed, for a full quarter, the price could peak between $110 and $130. If a full-scale blockade occurs, it might be goes up to like $150. How does the situation influence Korean economy? As a country that import nearly all its energy, South Korea is exceptionally vulnerable to these shocks. In April this year, Korea's consumer inflation hit a 2.6% year-on-year increase. I mean, Professor Shin says it has 2.2 core, so it might not be, worried much. But this has fastest pace in nearly 2 years, right? This was, driven by largely by a 21.9% spike in petroleum product prices. The consumer sentiment index recently fell to 99.2, crossing the threshold into pessimistic territory for the first time in a year. High energy costs act as a regressive tax, reducing the disposable income of middle and low-income families and stalling private consumption. In addition, the Korean won is weakened significantly, hitting the lowest point since the 2009 financial crisis. The BOK is under mounting pressure to consider interest rate hike. Probably, potentially, it might be in July, to defend the currency and curb inflation, despite the risk of slowing growth. Putting all things together, we may see the situation where rising costs squeeze the middle class, while broader economy remains stagnant.
Mm-hmm. So what's certain is that the situation in the Middle East, it's really raising uncertainty globally. And of course, the oil price, it's being a very big impact. And South Korean government, in fact, lately froze the 5th oil price cap, marking the 3rd straight move. Professor Shin, do you think this could be seen as a move focused on stabilizing inflation? And also, how effective would this measure actually be?
Of course. This current government has been dedicating on stabilizing above anything else, the inflation and mostly gasoline price. So there has been some criticism about how effective would that be of the price cap, but there has been 4 price cap in the previous periods, and now it is the 5th time. And if the oil price and gas price rise further, I think government will adopt stronger measures, much stronger measure to curb its effect upon gas prices. So I believe that at least in part, government is trying to alleviate, the problem of higher gas price affecting, the consumer. So of course, it's not 100%, but I think it's pretty effective so far, containing gas price on the gas pump.
Mm-hmm. But what about some other macroeconomic side effects that could come from these oil price cap system, Professor Kim? Could you tell us about that?
Yeah, I agreed, to Professor Shin's. I couldn't agree, Professor Shin's idea more. I 100% agree, but there might some side effect of these things, right? So this the energy price cap might serve as a short-term painkiller to curb inflation and inflation, right? But long-term inflation, often lead to significant macroeconomic distortions and structural weakness, including market disruption and supply shortages, worsening fiscal and public corporate health, and resource misallocation and overconsumption, distorted economic signals and policy failure, and finite potential for black markets and quality issues. So we assume that lasts longer, right? And so basically, when prices are artificially suppressed, the energy companies see reduced profit margins, leading them to cut back on exploration, production, and infrastructure maintenance. Over time, this leads to a domestic supply crunch. Moreover, once the cap is eventually lifted, prices spring back up violently to catch up with the market reality, and causing a much more severe inflationary shock later. Secondly, the global energy costs rise, but domestic rates are frozen. The state-run utilities like the Korea Electric Power Corp or Korea Gas Corp accumulate, massive deficit, these, losses eventually require taxpayer, funded bailout or the issuance of massive amount of corporate bond, which can, crowd out other borrowers in the credit market, drive up in the interest rate. Thirdly, artificially low prices remove the incentive for business and household to conserve energy, or invest in green alternatives. This leads to wasteful consumption patterns. I'm not, exaggerating, but this is what we're expecting, right? Increasing the country's overall energy dependency and trade deficit. It also, slow down the transition to renewable energy because, fossil fuels remain cheap. Fourthly, artificial prices make it difficult for Bank of Korea to gauge the true level of inflationary pressure in the economy. This can lead to policy errors. Finally, to bypass this price limit, off the books trading can emerge. Additionally, the distributors may lower the quality of the fuel to maintain their profit margins, which ultimately harms the consumer.
So it will be critical to see how the South Korean government would lead its economic direction from here. I would like to say thank you so much for both of your insights. Despite having different opinions, we really enjoyed it, and I think it was very respectful in all aspects. So I want to thank you both again. We'll have to wrap our discussion right here. Once again, thank you so much for your insights, Professor Shim and Professor Kim. We really appreciate it.
Thank you.
Thanks for having me.
And that'll be all from us on Within the Frame tonight. Be sure to tune in again next time as we continue to explore the stories that matter. Until then, stay informed and engaged.